Hey, it's Raf Ritchie from Nancy Chu Homes. I'm here with Dylan White from Loan Depot, one of our favorite lenders. And we're going to talk about something that's been in the news that I don't fully understand. There was something about there was an increased fee on qualified borrowers and a reduced fee on less qualified borrowers. What can you tell me about that?
Yeah, so there's definitely been a lot of news recently, I'll say worded very provocatively to get some clicks, and this idea that we're taking money away from well-qualified people specifically to give it to less qualified people, and that you're going to get penalized for having a higher credit score. And I've heard the jokes, oh, I'll just stop paying my credit cards and then I'll get a better interest rate. And while that sounds fun to not pay your credit cards and think that it'll work out well, it's just not the reality of the situation. Fannie Mae and Freddie Mac recently stated that they're going to make some changes to loan level pricing adjustments. And those are basically the factors that go into every single mortgage that someone is purchasing. And it's just sort of a matrix of different factors when it comes to your credit profile and your mortgage profile in terms of down payment and things like that. And all those things sort of factor into what your final interest rate is. And so they announced they were making some of these changes. They said effective May 1st, and we could talk about that a little bit after this. But basically, the reality of the situation is, even after they've made those adjustments, if you look at those loan level pricing adjustments or pricing hits, you are always going to be better off having a higher credit score than you will a lower credit score. The reality is they've just sort of tweaked the numbers a little bit to where maybe it's not as completely debilitating to have a credit score in the mid 600s versus previously where the hit was much higher and your interest rate was going to be higher, and it's sort of even more pricing you out of the market. And so these moves were made to just let more, I'll say, to widen the approval rating of people who are looking to get those conventional mortgages and provide an alternative sometimes to something like FHA, which also exists for first-time home buyers and those who might have some credit issues, and just give them an alternative product as well. Depending on the market where you're in, sometimes FHA is a little bit harder. Now you have a better chance of getting approved conventionally. You might get that offer accepted versus an FHA. And so it's there just to benefit and to really encourage home ownership among everyone that they can.
Okay. Now, you were saying this has been in the works for a bit.
Yeah, so they made the announcement a while ago, and everyone got focused on the date of May 1st. And the reality of the situation is that in the wording of it, it says it goes into effect for mortgages that are being sold to Fannie Mae and Freddie Mac on May 1st. So that means that loan has to have already gone through the entire mortgage application process, funded, and sort of been packaged up to be sold to them as the long-term investor. Meaning, if I have to plan ahead to sell something to you on May 1st, and I know that it's going to take 45, 60 days, whatever it might be, I've got to already start pricing that in way back. So the reality is, if you've talked to a mortgage lender at any point this year, even prior to May 1st, like I know multiple companies, basically from the moment that this was announced, they immediately implemented the changes so that all of those loans come May 1st would be eligible for sale. And so if you've spoken to someone during, March, April, you already have those, I'll say, updated rates in what you've been quoted. So it's not like if you talk to somebody on April 20th and now you're going to come back and talk to them mid-May and they're going to say, hey, your rate just doubled or something like that. That's not the case. There shouldn't be any change other than, your typical market changes from one to the other.
Okay. And you said market changes. Is this like a moving number anyway, or does a lot of hay has been made about this one thing, but does this move all the time anyway?
So the loan level pricing adjustments are essentially a fixed portion of what your mortgage interest rate is. And then the market is going to dictate where, I'll say, your base is, because everything like that, the LLPA loan level pricing adjustment basically means that you have sort of the base pricing for where the market has dictated interest rates to be. Right now we're in the low sixes or so. And then you take that base pricing, and then you're going to add each of these individual hits depending on, like I said, the sort of matrix that they have set up of maybe you have, a certain credit score with a certain down payment, you're buying a multifamily versus a single family. All of these things factor in a little bit in terms of what we're looking to do and what that final rate is going to end up being. So even if, everything stays the same, the market does move from time to time. Everything going on with the banking industry currently, everyone obviously has a fond reminiscence of what interest rates were like during COVID, and you could get something in the twos and threes potentially. So that market does move, and those LLPAs stay fixed the whole time. So you'll see some natural fluctuation regardless of LLPA changes.
Okay. All right. So give us an example, like a real world example of like who and how this affected, say, some of your clients.
Yeah. So like I was sort of alluding to, it's really meant to provide more options and sort of ease the barrier of entry to home ownership, because that's really through everything that they've been doing, even these changes that they've been making during COVID and things like that. Everything is trending towards trying to encourage home ownership, and specifically like a primary residence home ownership. So historically, they made some changes where second homes used to have interest rates similar to like a primary residence, even though you're not occupying it all the time. They then switched that to now second homes, the cost of those or the interest rate is similar to that of an investment property because it's not being utilized. And so that was part of a push towards encouraging owner occupancy and home ownership. This is just another step in that process in terms of, the reality of the situation, we're still coming out of a little bit the tail end of COVID and things that were happening there. A lot of people weren't working. Maybe you ran up your credit card bills or something like that. Your credit score took a hit through, objectively, let's say no fault of your own. Okay, now there's a little bit better opportunity for you to be able to have a competitive interest rate and be able to qualify conventionally. In terms of like our clients themselves, it's always going to be a little bit better. Sometimes it's a little bit harder to get an FHA offer accepted or a VA offer accepted because there's, certain expectations associated with that. And, I could talk about how that's a mistake to think those things, but that's a whole other video. But in this case, having that conventional option on paper just tends to give people a little bit more confidence in the process, a little bit more, confidence in accepting those offers. And it's just going to help, like I said, sort of encourage that home ownership. It's the other factor in terms that sort of goes hand in hand with this is that with the idea that we're pushing for first-time home buyers and owner occupancy and things like that, while they did just make all these loan level pricing adjustments and announce them and everyone's got their opinions on it, they also announced sort of a program where if you're a first-time home buyer, there are no pricing hits to your loan. So as long as you fit within a certain income track, you are getting just that base pricing. So every LLPA is waived. So for people who were,
Wow.
I'll say one of the big.
Is that a bigger deal than it sounds like?
It's a huge deal because a lot of the idea of this, I've been saving up.
Forgive me, I didn't mean to interrupt you, but
no, you're good.
Said all the LLPA is waived for first-time home buyers.
Yep. So, that idea that, hey, I've been scrimping and saving and I've improved my credit and I got my down payment and now you're going to tell me I have a higher rate. Well, actually, no, because if you're a first-time home buyer and there is an income qualifying factor in terms of being within a certain percentage of your AMI or your area median income, as long as you're within that band, every LLPA is waived. So regardless of credit score, down payment, you're going to end up with the same sort of interest rate that you're looking at. And that's a huge, huge thing that's going to help exactly that, encourage those first-time home buyers and sometimes give them a competitive edge versus someone who might be buying an investment property or something like that for being a little bit more qualified and having a stronger offer there.
Okay. I did read, now I did a little preparation. I did read that some of this is getting rescinded.
Yeah. So, as it is with anything, there is a public opinion factor of it. And while we've made those adjustments on our end of things, it it isn't necessarily completely set in stone yet. And so one of the announced LLPAs had to do with your debt to income ratio. And this was specifically if you have a debt to income ratio over 45, which is typically what your qualifying ceiling is. If you have a debt to income ratio above that, it was an additional hit on the rate. And obviously there was a little bit of backlash on that, because the idea that, okay, you're taking someone who's already a little bit tight in what they're looking to do, and now you're making the interest rate even higher and pushing that DT up even more, is a little bit counterintuitive. And so there was a lot of pushback against that specifically. And they've now announced, I think, the initial, same as everything else, is going to be loans delivered on May 1st. I think they've pushed that to further towards the fall. And realistically speaking, if backlash continues and they figure out some other way to sort of absorb that, they'll probably just do away with it entirely a little bit.
Okay. Now, I understand that some part of the LLPA has to do with risk, right?
Mhm.
How much of that, so, and the thing that, and forgive me, because I'm struggling with this in my head, right? Don't we all have like PMI on loans that are like less than 20% down? Like,
Yes. So you're going to see PMI on loans with less than 20% down. And again, that's the same sort of ilk in terms of, okay, now there's something else that's sort of letting us have a better interest rate for that less than 20% down buyer. So while you do have PMI, that's not necessarily the be all end all in terms of assuaging that risk. So think about, if you're thinking about historically, like the idea that you just couldn't get a loan with less than 20% down. Okay, then we created PMI. So now your interest rate is typically going to be the same if you're putting down less than 20% versus if you're putting down 20%. Sometimes, depending on the situation, you might see a slightly higher interest rate, or I think they might have evened this out. But historically, you might have seen a slightly higher interest rate putting down 20% than you would putting down, let's say, 15%, because that's that step of removing the PMI. And now the risk is back on whoever's holding the note here. And so you saw that uptick in interest rate. Right now, with PMI and things like that, it's what's allowing you to have an interest rate that is comparable to a 20% down payment. So even if your payment's a little bit higher, so let's say if you're putting down 20% and your rate is 6.125, and you're putting down 15% and your rate is 6.25, okay, you're paying a slightly higher interest rate because it's riskier and you're paying the PMI. But historically, if there was something like, historically, you wouldn't have been putting down less than 20%, or the jump was going to be much different. So an example of that would be something like lender paid mortgage insurance, or LPMI, where rather than pay that monthly PMI, it's baked into your interest rate a little bit. And so there you're going to see what the actual differentiation is in terms of, in that situation, okay, I'm putting down my 20%, I'm at 6.125. If I'm doing, my lender paid mortgage insurance and I'm putting down 15%, I may be at 6.875, 7%, whatever the case might be, dictated by, credit and things like that. So while that is there for risk, the PMI is there to keep it somewhat competitive and a little bit more breathable, I'll say.
okay. It's funny, I hadn't thought about it. The riskiest loan that gets put out is the 20% down loan, as opposed to the other one, because it doesn't have PMI. And
exactly, and
that's the risk sort of diminishes.
You're in that valley of.
Okay, so all right, this makes a bunch more sense. Now, at Nancy Chu Homes, we love nothing better than a chart. You want to give it a whirl?
All right, let's see if I've got this pulled up correctly.
There we go. All right, fantastic. I see it.
All right, perfect.
Okay.
So this is basically the new loan level pricing adjustments. And I'll say I'm not showing you any sort of secret behind the scenes mortgage info here. This is direct from Fannie Mae's website. You can Google LLPAs. This chart will come up. And so I just want to see if I have everything here. Okay. So these are historically our old rates in terms of what those loan level pricing adjustments. And you can look at them and see how different credit scores and things like that factored into different interest rates with your down payment. One of the biggest things you're going to see differentiated between the two is here, our score tops out at 740 versus our current scores. There's now 2 additional bands of 760 to 780 and then 780 and above. But what I really wanted to show on this chart is, like I was saying before, you're always going to be better having a higher credit score than you are having a lower credit score. So, we've got credit over here on this axis, regardless of what down payment we're looking at. As you go down the chart, you see those numbers increasing, meaning you're going to have a higher interest rate with a lower down pay or with a lower credit score. Now, is it different? And this is sort of the heat chart that shows the changes that were made here a little bit. So you'll see that 80%, things like that got a little bit worse in terms of what you're looking at. And the idea that down here, 640 and below, 630, oh, they got a huge break with putting down, less money. Even with this huge break, first of all, the idea that these loans are truly happening that often is a rarity. In those situations where you have pretty on the low end credit in terms of what conventional is looking for and a minimal down payment, more than likely you're going FHA, and that's going to be more financially viable for you. And it's going to be better in terms of getting your offer accepted and what you're able to do. So the idea that like all of these changes are subsidizing this, it's not really happening as often as you would think. And again, as you look through the stacks here, it's just everything's going to be more expensive, less credit. You'll see,
and that number is pretty high. That looks like it breaks pretty hard at that 699 threshold. So,
yeah, typically that's where you're looking to be. If you're taking sort of a diagonal across here, you want to be above in the 700 range. And then as your down payment, if your down payment's a little bit less, hopefully a little bit more, a little bit higher credit. Because again, it's all about risk assessment and the idea that if I'm someone who has, down here, more equity in the home, I'm more enticed to be invested in keeping this investment versus the idea that, oh, I have almost no equity in this home and someone else has a mortgage for the rest of it. If something goes wrong, it's not necessarily that difficult to sort of cut ties a little bit.
And that breaks really hard with more money down. I'm looking at this.
Yeah.
Okay.
Basically, and that's always a question. Actually, this is just a common question that we sort of get a lot is, oh, well, what'll happen if I put more down? Everyone, I want to put more down. It'll help my interest rate. As you can see here, for anything basically other than having a sub 640 credit, you're maxed out at 40% down. So putting down 50%, putting down 60%, there's going to be no benefit on the interest rate side of things. Obviously, your payment's going to be lower, and if that's what you're looking for, that's perfect. But in terms of that interest rate, the number itself, you've maxed out for the most part at that 40% down payment mark.
All right. Well, Dylan, thank you. I appreciate it. This helps. Yeah, let me turn off sharing. And is there anything? What did we not ask about? What didn't I ask? What am I not talking about? What do you need to let us know that I didn't address?
I don't think there's anything that we didn't necessarily talk about, but I think, and you sort of did mention it, I think the real focus should be a lot more on this first-time homebuyer sort of program that we have set up, and the idea that if you're within that income, you're getting no LLPAs. So while everyone is concerned about, obviously no one wants a higher interest rate and things like that, but the reality is for a lot of people that are applying right now, especially those, I would say, millennials, a little bit younger, those people who are buying their first homes, these almost aren't even going to be a factor in what you're looking to do. And so to get sort of in your head about it and like, oh, well, maybe I'll rent for another year because they're changing rates, that might not even be something that you are going to be affected by. And so it's important to know what your options are and ensure that you're getting those benefits. So there's definitely a lot that can be done. And I think, again, let's focus on the positive. Hey, we've got this great program for people who are looking to get into their first home. It's going to make things as affordable as possible. And then, again, even with slightly higher interest rates and things like that, it's a 30-year mortgage, but we're not at the, you're not necessarily in this for 30 years. You can always refinance should rates come down. So this isn't the be all end all of what your payment will be. And I think that's a little bit closer to the reality of the situation.
All right, Dylan, thank you. And we'll see you on the next one. You're coming to our food truck thing, right?
I am indeed.
Fantastic. All right. Talk to you later. Thanks a lot.